I predict there will be 5 massive changes coming to the credit card market in 2025. The credit card world is about to face its biggest shakeup in years. If you're not paying attention, you might find yourself stuck with a credit card from a bank you never intended to be in business with, or even unable to qualify for new credit cards altogether. Coming up, you'll see how credit card rejection rates are going up and leaving millions locked out, the rise of fintech credit cards shaking up the market, and why major players like Goldman Sachs, Chase,
Apple giving a nice off-ramp to Goldman Sachs and their credit card partnership. That was short-lived.
Capital One, and Discover
Capital One has announced a $35 billion agreement to acquire Discover Financial Services.
are making moves that could reshape the entire credit card industry as we know it. The first thing is tighter credit card standards. Across the country, people are feeling the squeeze as credit card issuers tighten their standards. Back in 2024, the rejection rate for credit card applications jumped to 19.6%, and that's up from 18.5% the previous year. That's according to the Federal Reserve. That means nearly 1 in 5 applicants is now being turned away. So what's going on? Delinquency rates are at their highest levels since 2010, with lenders writing off a staggering $46 billion in seriously delinquent loans in just the first 9 months of 2024. For issuers, it's a risk they're no longer willing to take, and the result is tougher rules across the board. And here's how it's playing out. For one, they have lower credit line approvals. So even if you're approved for a card, your credit limit might not be what you hoped. Lenders are slashing initial credit limits, especially for those without long credit histories. On average, subprime borrowers are often seeing credit limits drop by 15% compared to pre-pandemic levels. And then 2, there's higher credit score requirements. Do you remember when a 650 FICO score could get you in the door for a decent rewards card? Well, those days are fading fast. Many issuers are now quietly requiring scores closer to 700 to 720, shutting out those with less than perfect credit. And then 3, there's stricter income verification requirements. Lenders are asking for more proof of income than ever before. It's not just about listing your salary, they want tax returns and pay stubs and detailed documentation. This makes things especially tough for gig workers and freelancers whose incomes can fluctuate from month to month. And then 4, there's record high interest rates. Even if you manage to get approved, you'll still likely face sky high interest rates. As of late 2024, the average APR on new credit cards hit 24.1%, making it more expensive than ever to carry a balance. And for lenders, this is all about managing risk. Rising interest rates, inflation, and increased defaults have created a storm of uncertainty. And for borrowers with lower credit scores or spotty histories, it's becoming harder and harder to find options. But beyond the numbers, there's a human toll. Imagine applying for a credit card as a step toward improving your financial situation, only to be turned down. It's more than frustrating, it's disheartening. And it's not just affecting individuals, it's kind of reshaping the credit landscape. And I'd say looking ahead to 2025, there's really no sign of this trend reversing. As default rates creep higher and the economy stays uncertain, lenders are digging in and playing it safe. For many consumers, it feels like the door to credit is closing just when they need it the most. Another massive change coming in 2025 for credit cards is there's going to be new fintech credit cards coming out. And what I mean by that is digital-first fintechs like Chime and Current are shaking up the financial world, and they're not slowing down. These platforms have moved way beyond basic banking services, and they're rewriting the rules for how financial products are designed and delivered. With easy-to-use apps, no hidden fees, and features built for today's lifestyles, fintechs are leaving traditional banks scrambling to keep up sometimes. What's even more impressive is their sheer speed at which these fintechs are rolling out credit cards. While traditional banks might take years to develop and launch a new product, fintechs are sprinting ahead, using technology and consumer insights to deliver fresh and innovative credit products in record time. As we look ahead to 2025, the flood of new fintech credit cards shows no signs of slowing down. And unlike traditional banks, fintechs don't have to navigate outdated systems or endless red tape. They're lean, digital first, and laser focused on what their users actually want. This gives them a huge advantage when it comes to designing and launching new products, especially credit cards. And here are just a few fintech credit cards that hit the market this past year, showing how quickly these companies are stepping up to the challenge of beating the status quo. The first one is the Affirm Visa card. With its 2024 debut that blends buy now, pay later features with traditional debit card functionality. Then there's the Klarna credit card. that launched in April 2024. This card integrates Klarna's popular installment payment options into a full-fledged credit offering. There's also the Hyper credit card that was released in November of 2024, and that's targeting both personal and business users with expense management tools that feel straight out of the corporate world. And we can't forget about the Robinhood Gold card. That was rebranded from the X1 card in March of 2024. This card ties credit limits to income and syncs directly with Robinhood's investing platform. And while traditional banks still dominate the market, their slower pace and rigid systems leave them vulnerable to these nimble competitors. Younger, tech-savvy consumers are increasingly choosing fintechs over traditional banks, drawn by their promise of convenience, transparency, and sometimes flexibility. Now, looking ahead to 2025 is shaping up to be a year of big changes in the credit card world. Fintechs are breaking through barriers, offering smarter features, better terms, and more options than ever before. For us consumers, this means more choices and a chance to find products that truly fit our financial needs. And one of my favorite things about fintechs is how many of them offer pre-approval with just a soft credit pull. No impact on your credit score. Even better, some will show you your starting credit limit during the pre-approval process. Now, if you want a link to all the new fintech cards offering features like this, plus over 60 cards you can get pre-approved for without a hard credit pull, then you got to hit the link below to get instant access to my free credit card pre-approval master list. Now, another huge thing that's going to shake up the credit card industry this year is the Capital One and Discover merger. Now, imagine you logging into your credit card account, expecting the usual, only to find a totally new platform, updated terms, and changes to your rewards. That could become a reality for millions of Americans if the Capital One and Discover merger gets the green light. This merger isn't just big, it's massive. If approved, it would create the largest credit card issuer in the US, managing a staggering $250 billion in outstanding loans and potentially changing the entire credit card landscape in 2025. To put this into perspective, this is like two giants teaming up to dominate the field. Mergers of this scale don't happen every day, and when they do, they come with the ripple effects that could impact everyone from casual cardholders to the entire financial market. But what does this actually mean for you? Well, one of the biggest fears with a merger like this is less competition. When two major players join forces, it could leave cardholders with fewer choices, which might translate to weaker rewards programs or higher fees and fewer perks. Those cashback bonuses and travel points or zero APR deals you've come to count on, they could be on a chopping block. And with less competition, issuers might feel less pressure to offer cardholders the best deals. Now, on the flip side, there is potential for good to come out of this merger. Imagine Capital One's tech-driven innovation blending with Discover's reputation for standout customer service. Together, they could create a credit card experience that's both intuitive and supportive, potentially offering better fraud protection, smarter tools for managing your credit, or even brand new products altogether. But the question remains, will these potential upgrades be worth the trade-offs? We really don't know. But this isn't a done deal yet. The merger is facing serious scrutiny from regulators like the Federal Trade Commission, who are tasked with making sure the merger doesn't violate antitrust laws or harm consumers. These laws are all about maintaining healthy competition so that consumers don't get stuck with fewer options and higher costs. When two companies of this size come together, regulators look at whether the merger could create a monopoly or stifle competition. It's a delicate balance, allowing growth and innovation without sacrificing consumer benefits. And the outcome of this review will determine whether the merger moves forward or gets blocked entirely. Right now, it's a waiting game. The potential merger has everyone from the industry experts to everyday cardholders on edge. Will it bring positive changes like better technology and improved features? Or will it bring fewer options and higher fees and scale back rewards? For now, we'll have to stay tuned as regulators and both companies weigh their options. Now, if you're a Capital One or Discover cardholder, it's worth keeping an eye on this story. Whether the merger is approved or not, it's clear that the credit card industry is in for some big changes, and it's always better to be prepared for what's coming ahead. And another huge issue that's coming ahead is Goldman Sachs selling the Apple Card portfolio. Goldman Sachs is planning to offload the portfolio this year for a card that's already been criticized for its limited rewards and lack of standout features. Now, this shakeup leaves cardholders wondering, what's next? Could a new bank bring improvements, or will the Apple Card lose what made it unique in the first place? Goldman's decision to step back speaks to bigger challenges in the credit card industry as a whole, especially for co-branded cards like this one. When Goldman Sachs first teamed up with Apple, it seemed like a winning combination. Apple's cutting-edge design and tech paired with Goldman's financial expertise. But fast forward to today, and it's clear the partnership didn't go as planned. Goldman has reported $1 billion in losses from its consumer credit division, with the Apple Card playing a big role in the red ink. The card's no fees and everyone's welcome vibe might have sounded great on paper, but it came with problems. Approving applicants with lower credit scores meant a rise in delinquency rates as some users struggled to make payments. And add to that a $90 million fine from the CFPB over billing errors and interest-free financing issues, and the Apple Card became a bigger headache than Goldman could even handle. So Goldman is calling it quits, not just on the Apple Card, but on consumer credit altogether. After selling its GM credit card portfolio to Barclays, it's now looking to hand off the Apple Card to someone else. And all eyes are on Chase, which is reportedly in talks to take it over. Now, if Chase takes the reins, things could look very different this year. Chase is known for its strong rewards programs and premium co-branded cards like Marriott Bonvoy and Southwest, but these often come with stricter approval standards and annual fees. For Apple Card users who've enjoyed the card's simplicity and accessibility, this could be a tough pill to swallow. Stricter credit requirements could mean some current cardholders get pushed out, and there's a chance Chase might introduce fees to make the card more profitable. One likely change is the monthly billing cycle. Now, unlike most cards, Apple Card statements close at the end of the month, creating a surge in customer service requests all at once. Chase would almost certainly stagger billing cycles, smoothing out operations, but altering a feature many cardholders have gotten used to. And this isn't just about Goldman and Apple though. It highlights a bigger issue with co-branded credit cards. They're high profile, but high risk. Balancing the demands of a major brand like Apple with the realities of running a profitable credit portfolio is no easy task. For Goldman, it was a mismatch from the start, and now they're stepping back to focus on what they do best. But for Apple Card users, this transition raises a lot of questions. Will the rewards improve under Chase, or will new fees and stricter rules make the card less appealing? Either way, change is coming, and it's something cardholders will want to keep a close eye on. And another massive change I can clearly see coming this year in 2025 is the rising focus on strategic card management. Have you ever noticed how people are getting more intentional about their credit cards these days? It's not just about swiping and forgetting anymore, it's about strategy. A few years ago, most of us didn't give much thought to our credit cards. You applied, got approved, and stuck with the same card for years without a second glance. But now, people are getting smarter about how they use their cards, and it's completely changing the game. Hop onto a personal finance forum or Reddit thread about credit cards and you'll see what I mean. Communities like the Credit Cards Forum on Reddit or My FICO forums are blowing up. Over the last year alone, the Credit Card Reddit forum gained 111,000 new members, growing to 1.4 million subscribers. The My FICO forums aren't far behind, with 91,000 active members and over 5 million posts. These platforms are buzzing with people sharing tips on how to maximize rewards, avoid fees, and boost credit scores. And the idea is to get every ounce of value from your cards while staying financially savvy. This isn't just a niche interest anymore. It's going mainstream. People are earning enough points to book dream vacations or saving hundreds on everyday purchases. It's no wonder this trend is only expected to grow even more this year in 2025. One of the biggest buzzwords you'll hear in these spaces is gardening. And no, it doesn't involve plants. It's all about credit card strategy, taking a break from applying for new cars to let your accounts age and then paying down balances and avoiding hard inquiries. And why do we do this? It's because we want better credit scores, and that leads to higher limits, lower interest rates, and access to premium cars. Instead of jumping at every flashy new offer, people are focusing on the long-term benefits. And it's not just about individuals who are adapting. Credit card issuers are feeling the heat too. A simple sign-up bonus isn't enough to keep people loyal anymore. Consumers are now smarter, and they expect real value, whether it's higher cashback rates, better travel perks, or unique features that make their lives easier. If a card doesn't deliver, it's out. This shift towards strategic card management is part of a larger trend in how we think about money. People aren't just spending, they're spending smarter. They're informed, intentional, and empowered to make financial decisions that align with their goals. It's really a new era of credit card management, and honestly, it's about time. I've noticed that people put and a lot of strategy around when they should ask for a credit limit increase. I've even found one person who increased their credit limit 9 times to $66,000 by scheduling their increases on a specific month. Definitely click the next video here to learn how they did it, and thank you for watching.